Thank you. Welcome to the January 20th CalHFA Board of Directors meeting. We welcome everyone. There will be an opportunity for members of the public to address the board, and instructions will be provided at that time. However, there are instructions that you can view looking at the handout section on your GoToWebinar menu, as well as on our CalHFA website. There's also the board meeting packet located at both places, and post-meeting we will publish all the meeting materials on that website as well, on the CalHFA website. So without further ado, I'm going to turn over to Chairman Michael Gunning.
Awesome. Thank you, Melissa, and thank you, everyone. Happy New Year to everybody. Can't believe we're back here in a new year, ready to go, huh? How about a roll call, Melissa?
Certainly. Ms. Avila Farias?
Here.
Ms. Gallagher?
Here.
Dr. Imbasiani?
Here.
Mr. Gunning?
Here.
Mr. Hunter?
Here.
Treasurer Ma?
Here.
Ms. Dodson for Director Velasquez?
Here.
Ms. Kerrigan for Secretary Castro Ramirez?
Here.
Mr. Prince?
Here.
Mr. Russell?
Present.
Ms. Sotelo?
Here.
Mr. White?
Here.
Mr. Silber for Mr. Acefa?
Here.
Ms. Miller? Not hearing Ms. Miller. Mark her absent. Ms. Johnson Hall?
Here.
Chairman Gunning, we have a quorum.
Awesome. And I know there was a few names, Melissa, that are new. And I know that Sasha Kurgan, who's here with HCD, is attending for the first time. And I think is it Janine? I think Janine Dotson, welcome. Thank you for also participating. Please feel free to speak up when you want. Has everyone had a chance to take a look at the minutes from last meeting? Were there any corrections, I should say, to the minutes from last meeting? All right, seeing no hands up, I move we adopt the minutes by acclamation. Thank you. Moving on to opening comments. I think I'm gonna hand the baton to Tina, but certainly want to welcome everyone. I know it's another year and it feels like it's almost deja vu all over again. I was thinking that I remember we did a board meeting in March of 20, and I think it was the last meeting, and I still have the hand sanitizer from that meeting 2 years ago, and here we are still doing it. So really appreciate everyone's engagement and enthusiasm. And with that, Tina, I'll turn it over to you.
Well, thank you, Chair Gunning. I'd like to also welcome you all of my board members back to a new, fresh calendar year, as well as members of the public. Thank you for joining us today. As you might imagine, we've been very busy since our last board meeting, as CalHFA has actually reached some huge milestones that I'm excited to recap for you today. As the board knows, a portion of our staff has been hard at work designing a program to disperse our state's allocation from the Homeowner Assistance Fund, or what we affectionately call HAF, and running a pilot version of the program and working with U.S. Treasury to get approval of the California Mortgage Relief Program plan. Well, we got Treasury approval on December 17th, and only 10 days later, we opened the full program just after Christmas. At that time, we were the third agency in the entire country to officially launch. And what makes that even more impressive is that California's allocation of $1 billion is just over 10% of the total amount of HAF funds that will be allocated to the country, United States. That's pretty impressive. CalHFA's Director of Enterprise Risk Management, Rebecca Franklin, who serves as the president of the CalHFA Homeowner Relief Corporation, will provide an additional update on the program later in the meeting. but I'll just fill you in on the press event that we did on January 5th. Following introductory remarks from myself, Secretary Lourdes Castro Ramirez, DFPI Commissioner Chloe Hewlett, and the author of the HAF legislation herself, Congresswoman Maxine Waters, Rebecca did an incredible job introducing the program to the press. And we were especially honored to be joined by Congresswoman Waters, who told the assembled press that California has been in the forefront of responding quickly and well, and they understand what they can do to simplify the program so that those who apply do not encounter difficult procedures to qualify. So it was great to get that recognition. I am a huge fan of Congressman Waters myself, and so to have her join us was just simply terrific. But $1 billion going to struggling homeowners, that's big. And so we are treating it as a big deal, and we are going to work very diligently to get those funds out as quickly as we can. Another piece of news is our mixed income program launch. That happened on January 4th. As you know, that is one of our flagship loan programs, and all of you are quite familiar with it. I'm excited that our Director of Multifamily Programs, Kate Ferguson, she'll provide an update later and give you more details on the successes we experienced in 2021, as well as what to look for in 2022. And then I want to mention the budget release. And I'm only going to mention it because Deputy Secretary Sasha Kerrigan is going to give us a full in-depth report on what that looks like. But I want to share with you that the success we've had with MIP has led the governor to propose another $200 million in mixed income funding to come to CalHFA in the 2022-2023 blueprint for California state budget. That was another big milestone earlier this month as Governor Newsom presented the budget proposal. And then later that day, I joined Secretary Castro Ramirez, Director Velasquez, and Director Accessory on a housing stakeholder call to follow up on some of the key items. And as I mentioned, Sasha will deliver to us a more in-depth, but somewhat short presentation. I would encourage you to read the entire blueprint on your own when you have time. Before we get into those presentations, I wanted to give you a few thoughts about the ideas the governor presented and how they align with our priorities here at CalHFA. The administration is once again emphasizing that the housing shortage is one of the most daunting challenges facing the state. And the resources and initiatives proposed in this budget make it clear that addressing that shortage remains a key focus for the upcoming year. I was also happy to see the governor present the goals of equitable housing production and climate resiliency together as a comprehensive overall strategy, because that matches up with CalHFA's thinking over the past years, and we have designed programs to consider both of those two objectives. Additionally, we paid particular attention to the administrative stated priority of increasing California's affordable housing options. We will have VLI, ELA housing, which we believe is quite important. And that also, of course, aligns with the direction Calicheva has been going for a long time. So, as you know, our multifamily lending goes towards projects that create and preserve units at a mix of low incomes, and our home ownership programs have been serving both low and moderate income homeowners very successfully for the past decade. And again, I'll just mention the Deputy Secretary, Ms. Kerrigan, will give you a full picture of the proposed budget later on. Looking forward. Since this is our first meeting of 2022, I want to close out by saying that we are looking forward to a great year. But at the same time, we cannot deny the challenges that we continue to face. And the biggest one, Chair Gunning mentioned when he opened the meeting, the pandemic rages on. and continues to highlight the increasing gap between the haves and the have-nots, it's also becoming clear that we are going to be operating in a rising interest rate environment. All of that means we need to be more focused than ever and more vigilant. Fortunately, our hardworking CalHFA staff is poised to do just that. We're hitting the ground running this year with the launch of the Mortgage Relief Program, our 2022 Mixed Income Program, the continuation of our NMS counseling and ADU grants and more. And the administration and legislation, as they continue to be focused on housing, we're anticipating that there will likely be more bills introduced for more money that'll come to us. Frankly, while this does mean more oversight and possibly more responsibility for us, I take it as a compliment that these bodies see us as good stewards of the state's funds. And perhaps the most important path forward that CalHFA will undertake is the continued collaboration and information sharing with the administration, BCSH, our fellow housing agencies, and of course, the leadership of our board of directors. So thank you, and on with the agenda. Turning it back over to you, Mr. Chair Gunning. I apologize because there's an ambulance in the back here.
We know you're in the office there, right? All right. Thank you, Tina. Strong words. Good stewards of the state's funds. I just want to echo that, and kudos to the staff and team there and your leadership, Tina, with that, because that's important and clearly recognized by the administration and others for all the work you've done. So with that, why don't we go ahead and jump into the meeting? I think the first item up is number 4, our single family programs update. So I believe, Don, you're leading this one.
Good morning, Chair Gunning and members of the board. Don Kavir, Chief Deputy Director. And I too want to extend a Happy New Year to all of you and to tell you how excited the team and I are to update you on the programs and initiatives that we've been working on for the past several months. As many of you know, we've had no shortage of challenging work in front of us, including the official launch of the Mortgage Relief Program last month, the creation and implementation of a statewide ADU program, not to mention the design and future deployment of new single-family programs focused on sustainable homeownership and wealth creation. I'm going to kick things off this morning by providing a general status update on our single-family program and offer some perspective on what's happening in the single-family real estate market and how we anticipate current market forces will likely impact our program for the remainder of the fiscal year and into next. Joining me this morning to help with the updates are several of my colleagues, including members of our single-family lending team, who are directly responsible for the deployment of initiatives that I just mentioned, and from our Director of Business Development and Stakeholder Relations, who has been a great help in coordinating and organizing our efforts to move several of these complex initiatives forward simultaneously. Next slide, please. To help frame the conversation, I'd like to start by discussing the role CalHFA plays in the single-family ecosystem. First and foremost, CalHFA is not a direct lender. We are statutorily prohibited from lending directly to consumers, and our business model is designed to serve a particular subset of the market, specifically low and moderate income first-time home buyers, which we define as families that have not owned a home in the last 3 years. The single factor that makes our program relevant in the marketplace is the ability of CalHFA to provide homeowners with their minimum required down payment, as well as help them with closing costs. CalHFA's business model has always relied on access to the capital markets to fund our activities, and after struggling to survive the balance sheet losses sustained during the financial crisis, our model further evolved to focus on the delivery of GSE conforming mortgages into the secondary market, rather than retaining them on our balance sheet. In short, the loans we acquire from our network of lender partners are pooled together based on certain characteristics, primarily interest rate coupon, and they're securitized and sold to investors through the capital markets. The model is both financially advantageous and it mitigates the real estate risk inherent in owning and servicing whole loans. In addition to focusing on first-time home buyers, CalHFA places great importance on sustainable homeownership, on assisting historically underserved groups and markets. It is not just about getting families into their first home. It's about giving them the best products, tools, and educational opportunities to be successful as homeowners. With that in mind, I'm going to hand over the conversation to Cheryl Angst, one of our section chiefs in single family, to provide a brief overview on our available loan products, the primary locations of our lending activity, and the demographics of the people we serve. Next slide.
Thank you, Don, and good morning, board members. In 2013, CalHFA changed its lending model and entered the TBA, or to be announced, business model for selling closed loans to the secondary or capital markets, delivering mortgage-backed securities through our master servicer, Lakeview Loan Servicing. By doing this, we began to deliver loans to the GSEs, or government-sponsored enterprises, such as Fannie Mae, FHA, USDA, and VA. By expanding our programs to follow the GSE guidelines, CalHFA was able to offer and better serve borrowers. As such, we helped 4,100 borrowers purchase condominiums. 3,000 borrowers have purchased new construction homes. 900 borrowers have purchased manufactured homes. 179 veterans have purchased homes. 35 borrowers have purchased homes with ADUs. And not to mention, we also helped borrowers purchase homes that were leaseholds, community land trust, or energy efficient. 95 to 100% of all of these loans had a My Home down payment assistance program with it. This fiscal year to date, through December, we have done $37.2 million in My Home loans and $1.1 billion of first mortgages. Next slide, please. CalHFA continues to offer our programs in all 58 counties. However, much of our business continues to come from the Central Valley and Inland Empire. The lack of supply and high home prices are limiting the number of loans we purchase in high-cost counties. Next slide, please. CalHFA also continues to outperform the 2019 Census Bureau demographics in serving Hispanic and African American borrowers. Additionally, 75% of California low to moderate income borrowers have an annual income level under $100,000. Next slide, please. And I'll return you to Don.
Thank you, Cheryl. I'm going to pivot the conversation now to how today's market forces are impacting our program. To do that, I'm going to focus on what I believe is the most obvious driver in today's market, and then touch on some of the interrelated factors that contribute to where things stand this fiscal year and likely beyond. As I mentioned previously, CalHFA is an indirect lender whose infrastructure products and services, like other lenders, are designed to address the demand side of the market. The real problem is the complete and utter market imbalance that exists between housing supply and demand. The lack of supply has cut its way through the entire home ownership market and has been especially tough on the first-time homebuyer market, in which the scarcity of inventory at lower price points is driving up prices and increasing competition. At the risk of stating the obvious, at any given point in time, a variety of social and economic factors influence lending activity across sectors, and inevitably those factors filter through and impact us. The pandemic, inflation, consumer confidence, the Fed telegraphing multiple interest rate hikes over the coming years, these are all variables we don't control and which impact our business either directly or indirectly. However, there's no getting around that the supply of homes affordable to the target market of first-time homebuyers we serve is an even more constrained subset of an already strained housing inventory. As a consequence, the lack of supply and high demand creates competition, and this competition for homes has been amplified by prospective homebuyers in the higher income brackets and by corporate investors, both of which can bid up properties and come in with cash to close and close very quickly. Next slide, please. A recently published housing market update by the California Association of Realtors had some really interesting statistics that I've shared with you on this slide. And this data is a year-over-year comparison of the 12-month period ending September 2021. As you can see, we saw the median home price in California increase 13.5% to $809,000. There's less than 2 months of inventory for sale. Homes are on the market for, on an average of 10 days and are closing in excess of listing price. Because of this lack of inventory, overall sales in California are down year over year 5%. But as you can see, the price point of homes that we typically serve, it's double digits, and it's significant in terms of the year over year decline in sales within those price points. Next slide, please. So how has this market dynamic impacted CalHFA's single family programs? Well, we've seen a 30% decrease in reservations year over year. While this is a significant drop, you'll also note that our numbers have been relatively stable throughout the entirety of 2021. So you ask yourself, what does this mean? It's hard to say for sure, but we believe that CalHFA has the best first-time homebuyer products in the marketplace. And to the extent that there is inventory available for low and moderate income homebuyers, CalHFA continues to garner market share and have relevancy in the marketplace. Having said that, it also means that we are not likely to meet our aggressive business planning goal of $3 billion in first lien loan production this fiscal year. Next slide. So where are we going to end up? Based on our actual production from July through December of 2021 of just over $1.1 billion, we're revising our forecast for fiscal year 21-22 to $2.35 billion, which is roughly on parity with last year's actual production levels. The chart reflects our historical production goals, our mid-year revisions, and our actual lending activity for the last 7 years, as well as this year's production goal and our mid-year revised projection of 2.3 million. So make no mistake, 2.3 billion by anyone's standard is another strong year for our program. But the supply issues and related market forces we discussed can't be ignored. As a lender, CalHFA is not in a position to do much about the supply side of the problem, but we cannot be complacent either. We must constantly be evolving with the mortgage markets and developing new products to help as many low and moderate home buyers achieve their goal of home ownership, and to do so in a sustainable and equitable way. Next up, I'm going to hand over the conversation to my colleague Ellen Martin to provide status updates on some new products we are launching and scaling in the coming months. But before I do that, I will pause for any questions from the board up to this point.
Any questions from board members? So thorough, Don.
Don?
Actually, I do have a question, if I may.
Go ahead.
This is the Director Russell here. So in terms of the revised number, what is our revenue, our net revenue? How does that affect our bottom line as an organization? Is question number one.
Well, I would think that, when we've reforecasted that out, and I apologize, I don't have the number in the forefront of my memory, but with a 30% reduction in reservations that we've seen, my guess is probably close to a 30% reduction in net revenue. It will be awfully close to that. I would be happy to look at that and give you guys a renewed projection on that. I would say that at $2.3 billion of production, we more than cover the cost of the program and beyond. So I think there's no immediate area of concern from my perspective, but it definitely, any dip in sort of your production estimates are obviously going to trickle down and affect net income. So.
Okay, and the context, because 30% reduction is, within that program is clear in the larger program. My second question, and I'll yield to Dr. Bashiani, is really more of a comment. I'm currently sitting on Mayor Todd Gloria's set up a middle income housing working group locally. And one of the things we've seen is that to deliver home ownership product at a level that's affordable at 100% AMI and below, we're going to have to substantially reform the construction defect litigation regime that prevents anyone from actually building new ownership product. And I just want to say, yes, we cannot do much on the supply side as a lender, but as a political force, I think we should look at what positions we take vis-a-vis the production of new condominiums or different ownership models like co-ops that may not be affected in the same way by existing construction defect litigation regulations. So that's a comment rather than a question. Thank you.
Thank you, Stephen. Dr. Imbasciani?
Yeah, Mr. Kabir, a question from Director Imbasciani. Could you go back to the last slide where you had the mid-year revises?
Can you take us back there, Courtney? Right here?
Yes, great. It's surprising because it's the first time in almost a decade that the mid-year revise is lower than the budget. And I know that you have a crystal ball and you keep it very, very nicely polished. I'm wondering, can you prognosticate to, is this the start of a trend, or if it is a trend, will it be reflected in your blue bar for next year, your budget estimate?
It will definitely be factored into next year's budget estimate. And to your point, my crystal ball is not always the best, but having said that, I feel safe in saying that I feel like we're going to have relevancy in the market to the extent there is a market, but as supply continues to dwindle and that issue is not addressed in any meaningful or scalable way, I think that we're going to see a natural sort of ceiling on what can be done in the marketplace for first-time home buyers. That's my personal opinion. And if there aren't any homes for people to buy, then you really can't, you can't continue to grow the business. And so I think that is going to be something that we're going to see over the years to come as a real issue that is continuing to build. And as the competition continues to be fast and furious, it's doing is driving up prices and making that available inventory out of reach of the low and moderate first-time home buyers. I mean, that's my opinion. And so I feel like we're definitely going to be dialing back our estimates and kind of continue to watch what's happening in the marketplace. It's also not going to be helpful that interest rates are going to increase and actually have. So as you well know, when the Fed or anybody telegraphs rate hikes, the market immediately starts to address that potential and starts to factor increases into the marketplace. And I think Cheryl, if Cheryl's still on the line, I would just ask her. She's our head of secondary market delivery, and she does our pricing. And I've seen probably a 3/4 point increase in our published rate to borrowers within the last month. And so, and that's indicative of what the market is requiring in order to sell. And so maybe, I don't know, Cheryl, can you give them some specifics on that, where we're at and where we've been?
Yeah, the market, you're correct. We have about a 3/8 increase in rates. Currently, the 2.5% coupon and the 4% coupon, which is the coupons that we're actually exiting and the coupons that we're actually entering with the higher rates, have no value. So the pricing has been very, very tight. It's been extremely volatile.
So I just bring that up because I think that's also a interrelated pressure that is also going to not be helpful to low and moderate income home buyers.
Well, thank you. I did buy some glass cleaner. I'll be happy to send you some.
Sure, I'll take whatever you got. Yeah, I'd love to be able to predict more accurately.
Or an eraser. Thanks, Don. Any more questions from board members?
Yes, if I may.
Go ahead, Mr.
Director Russell here. So I guess my question is that are we lending in the multifamily home ownership space at all? Are we strictly in the single family business?
We're strictly single family home business at this point. We are looking to expand to, I believe, The proposal that we've been given is duplexes, 2 units up to 4, which is the definition of single family in the GSE market. As far as, we do lending for condos and things like that. So when you mention multifamily home ownership, I'm assuming you're talking sort of condo structures, but we do condos and we don't have any barrier to doing those. So we do them all the time.
Okay, thank you.
Any other questions from board members? All right, let's continue on with the SB 129 Home Buyer Assistance Fund update.
All right. Thank you, and good morning, Chair Gunning and members of the board. I'm glad to have the opportunity to introduce myself. My name is Ellen Martin, and I am CalHFA's new Director of Business Development and Stakeholder Relations. So as Dawn mentioned, today I will be partnering with Nick Koufasimas to offer an overview of our proposed use of the SB 129 Home Buyer Assistance Funds. Courtney, could we go to the next slide, please? So the Budget Act of 2021 allocated to CalHFA $100 million from the general fund for the purpose of providing homebuyer assistance. After evaluating several alternatives to deploy these funds, CalHFA staff now proposes to allocate $88 million to a new forgivable down payment assistance program and $12 million to fund loans for phase 2 of Caltrans State Route 710 affordable sales program. These proposed uses support the administration's goals of creating more affordable housing opportunities that target deeper affordability and also importantly, facilitating the disposal of Caltrans owned properties while simultaneously avoiding displacement of those current residents. Next slide, please. So I'll offer just a brief overview of the proposed forgivable down payment assistance program, and then I'll turn things over to Nick for a bit of a deeper dive into the State Route 710 affordable sales program. So the forgivable down payment assistance program will be available to households earning 80% or less in area median income. It would offer a forgivable loan sized at 10% of the home purchase price to be used for down payment and closing costs. The funds could also be used for other purposes such as an interest rate buy down or prepayment of mortgage insurance, which would of course have the effect of reducing ongoing mortgage costs and making home ownership more attainable. And then most importantly, the forgivable loan would be offered at 0% interest and would be forgivable over 5 years, offering low-income home builders the ability to realize significant equity gains that will make real contributions to wealth creation for those buyers. So sort of linking back to the ideas of sustainable home ownership and equity building that Dawn talked about. So with the next slide, I'll hand things over to Nick to talk about the State Route 710 Affordable Sales Program, and then we'll have an opportunity for questions related to both programs at the end of the presentation. Nick?
Super. Thank you, Ellen. Good morning, Chairman Gunning and board members. I'll be discussing the State Route 710 Affordable Sales Program. The extension covers, the 710 extension covers Los Angeles, South Pasadena, and Pasadena. There's approximately over 400 single-family homes and multiple commercial and multiple units that are included in this project. The project is broken down into 3 phases. Disposal of the property is governed by the Roberti Act and legislation, but the homes that are occupied by the low to moderate income tenants are offered the first right to purchase those properties. Next slide, please. In phase 1, we were successful in providing 7 separate loans to the low and moderate income home buyers. The 7 loans totaled about $1.1 million. I monitor those loans monthly, and we were successful in not one loan has become delinquent in the last 4 years. Phase 2 is going to be, it'll approximately be around 118 properties that will be offered to the low and moderate income households. We're expecting the total amount to be about $12 million, which we appropriated from SB 129 to purchase these first loans. And the principal and interest portion of the equity gains to be retained by CalHFA and used per our statutes. Next slide. So as CalHFA, we're not allowed to originate loans. So we have about 101 approved lenders. So we're fortunate to find one of our lenders, Mountain West Financial, that did provide the origination of those loans for phase one, and they have agreed to provide the finance, or they've agreed to originate those loans for phase two. So they originate the loans, we purchase the loans from them, we service the loans through our subservicer, which is DMI. And I monitor those loans monthly just to make sure if one goes delinquent, I'm able to jump in and help these home buyers bring their loan current and be able to stay in the property. We enforce resale restrictions. Those properties are required to be owner occupied. They have to live in those homes. If they do move out, we can pursue foreclosure, and that's the last thing we want to do. So Caltrans is responsibility. So we put parameters around these loans that we will purchase. So one is being homebuyer education. Caltrans has, so these individuals that are purchasing homes basically have no money. So we require that they pay for all the non-recurring closing costs, which are the title, escrow fees, origination fees, appraisal fees, and all that. We do offer a second loan, which is the My Home, that they can use to cover the recurring closing costs, which are the taxes and insurance. The homes have to be to FHA standards. All Section 1, Section 2 of the pest report have to be cleared. We do require a 2-year roof cert and a 1-year home buyer warranty. Liability indemnification for CalHFA, and we ask that they reimburse us for all administration costs. Next slide, please. So with the interagency agreement with Caltrans is that the repayment proceeds and net equity that we can determine where they go, liability protection and indemnification, the loan level requirements that I discussed previously, the physical conditions of the property meet FHA standards, and the regulatory agreement. And hopefully with phase two, we will be able again to provide a good portion of those low to moderate income buyers home ownership who otherwise would have the opportunity to have that. Next slide. And that's all to you all.
All right. Thank you very much, Nick. So to implement the programs as proposed and as discussed in this presentation, we need board approval to accept the SB 129 funds and to deploy them as we've described. Furthermore, because phase one of the Caltrans Affordable Sales Program limited our participation to that phase only, we are seeking reauthorization of our participation in phase two in line with the roles and responsibilities that Nick outlined. So staff therefore recommends the actions that are summarized on this slide. First, we are requesting approval of Resolution 2201, authorizing our participation in phase two of the State Route 710 Affordable Sales Program. And then contingent upon that approval, we are then requesting approval of Resolution 2202, accepting the $100 million in SB 129 appropriation and allocating those funds as described. So with that, we'd be more than happy to take any questions.
Hey, Ellen, this is Michael. I had one question. How many units are we talking about here over phases 1 and 2?
So in phase two, there are 118 properties that might be eligible for sale to low and moderate income home buyers. And then Nick will need to fact check me here, but I think in phase one, there were a total of 42 properties.
There was about 70 with 42 potential, and we were able to get 7 people into.
I'm sorry, Nick, say that again. I didn't catch all that.
I believe phase one was around 70 properties. 40 were potential low to moderate income buyers. We were successful on getting 7 into the financing to purchase those homes.
So does that mean the other homes go to different income people, or help me appreciate that?
Well, there's called the reverting waterfall. So first it's offered to the tenants that live in the home. If it's vacant, then it just goes to market, but then it goes to the HREs and then goes to market.
Thanks,
Mike?
Nick. Yeah, Dr. Bassiani, go ahead.
Thank you. Maybe being informed by the fact that I live close to these properties and drive past them quite regularly and read about them in the LA Times. In fact, I thought 710 referred to the number of years it would take actually to solve this issue. I'm so glad, but the serious question is, this is phase 2. It doesn't say final phase, but when I read the program, it seems to put a nail in the coffin, if you will, that it will finally dispose of this and that there won't be a phase 3. Am I correct?
I've heard there's going to be, well, I've heard there's going to be a phase 3. I'm not sure if it's changed.
What would it do? It looked like all the properties are accounted for in phase 2.
I haven't heard that. Good question.
So we'd be happy to get back to you with additional details from Caltrans about, the timing of total sales for phase 2 and what the expectations are for future phases.
Okay. Thank you.
Thanks, Ellen.
Chair Gunning, may I make a comment?
Yes, please, go ahead.
Great. This is Sasha Kurgan, Deputy Secretary of the Business Consumer Services and Housing Agency. I just really want to commend Ellen and Nick and the Calicheva team for stepping into this. I do support these actions for Calicheva to do this work. As Ellen mentioned, and I just want to reiterate, this is very important for the administration, specifically to support the opportunity of homeownership with this very unique land situation that Calicheva knows very well from phase 1. But I'd offer that this proposal can help further Calicheva's mission of serving low-income households and providing sustainable homeownership options. Again, I just really appreciate Calicheva's collaboration and participation to support state partners and hopefully the future homeowners that will live within this corridor. Our agency secretary, our partners at the California Transportation Agency and Caltrans really appreciate Calicheva's involvement and expertise. And when I say expertise, I mean not only Calicheva's expertise within the 710 corridor, and Nick, I think, knows the background on phase 1 better than anyone, but also Calicheva's expertise more broadly of homeownership options that include a focus on equity, really centering people, and making all of these reasons make the Calicheva team really uniquely qualified to do this work. Thank you.
No, thank you, Sasha. Well said. Appreciate the kudos. Any other board members with questions?
I also have a comment. I'm happy to move the item if we're prepared.
I think so, Mr. Russell. You can make the motion. Go ahead.
Okay. Well, so I will say, as being part of a community that was similarly impacted by freeway construction, was a very different outcome. I understand the complexities of this. I'm really appreciative that Caltrans was brought to a place that they are willing and eager partners. Most importantly, I think it's a really significant fact that we are seen, CalHFA, as a good partner, that we're given the hard stuff to do, the complex things, not the standard transactions. And I just want to really commend everyone on this board who has been here, who helped us to step up to this. And I would move. I think we're doing separate. Typically, staff likes us to do separate motions, so I will move Resolution 2201 for approval by the board.
I second that.
Who was that?
Dr. Bassiani.
All right, thank you, Doctor. There's been a motion and a second, but I'll leave it open. Any other questions from board members or comments from board members?
Director White, I have a question on phase 1 regarding the 70 properties. Can you break down again just the how those were sold, what income levels? It sounded like 40, and then I heard 7. Wanted to categorize the specific sales by incomes?
They're low to moderate income, and I believe the highest it can go up to is 150% AMI.
So then we generated or purchased 7 loans to low and moderate income home buyers. The remainder of the 40 or so properties that were occupied by low and moderate residents were first offered to those residents, but they did not ultimately purchase the homes, as I understand it.
Correct.
Okay.
So Fred, I'm assuming you mean then, so what happened with the other?
Right, so the 40, they did transact, right? But not to LM.
Not to LMI, right?
Chair Gunning, if I could respond a little bit, and maybe Nick could fill it in. I think he sort of mentioned it briefly, but of the 40 plus that were targeted to low and moderate income tenants, the 7 that effectuated the sale obviously purchased. The remainder then were offered in what they call the waterfall, in which housing related entities within the area are offered the opportunity to purchase the homes and to, I think, lease them at affordable levels, or they go to market. And so I don't have a breakdown of the remaining units of which ones went to an actual HRE, if any, and which ones were sold to market. I don't know if Nick, if you know that information.
I believe one went to an HRE, last I heard from Caltrans. But just to give you a little background, is they have a contractor out there, which is a real estate company that meets with all these affordable buyers. And what they do is they qualify them and determine the sales price. Now, the sales price cannot be under the acquisition cost that Caltrans purchased that property for. So we make, even if they don't meet the lending criteria, we do take a second look at them to look for compensating factors. The goal is to keep them in the property. The other goal is to make sure they're able to afford that payment. But that's how they're able to determine the sales price, and then the qualifying component comes over on our end.
Great, thanks, Nick.
Thanks for the explanation.
Any follow-up, Fred? You okay?
Yeah, I'm good.
Great. Any other questions from board members? Excellent. If not, let's get a roll call on resolution 22-01. Melissa?
Okay, Ms. Avila Farias,
Yes.
Ms. Gallagher,
Yes.
Dr. Imbasciani,
Yes.
Mr. Gunning,
Yes.
Mr. Hunter.
Yes.
And I will make a note here that Treasurer Ma needed to leave the meeting, so she has her alternate here, Noah Starr. So Mr. Starr, your vote, please.
Yes.
Ms. Dodson,
Yes.
Ms. Kerrigan,
Yes.
Mr. Prince,
Yes.
Mr. Russell,
Aye.
Ms. Sotelo,
Yes.
Mr. White.
Yes.
Chairman, resolution 22-01 is approved.
Awesome. Thanks, Melissa. Thanks, board members. Our second resolution, is there a motion?
I'd like to make a motion. This is Director Sotelo to approve resolution 2202.
Thank you, Director Sotelo. Is there a second?
This is Director Hunter. I'll second that.
Seconded. Sounds like a song. All right. Thank you, Jonathan. Melissa, roll call, please.
Ms. Avila Farias,
Yes.
Ms. Gallagher,
Yes.
Dr. Imbasciani,
Yes.
Mr. Gunning,
Aye.
Mr. Hunter,
Yes.
Mr. Starr,
Yes.
Ms. Dodson,
Yes.
Ms. Kerrigan,
Yes.
Mr. Prince, Mr. Prince, I didn't hear your. Let's see, have we lost Mr. Prince?
I don't see him on my screen. I have seen him, but
Yeah. One more time, Mr. Prince,
we can come back.
Mr. Russell,
Aye.
Ms. Sotelo,
Yes.
Mr. White.
Yes.
I'll try Mr. Prince one more time. And I'm not hearing Mr. Prince. Cool. So with that, resolution 22-02 is approved.
Let's come back and ask Preston when he's back on screen, Melissa.
Okay, thank you.
All right, continuing agenda item 4, we have sub C, accessory dwelling unit grant program update. Ellen, is that you again?
Yes, it is. Thank you.
Great.
All right. So thank you, Chair Gunning. Again, for the record, Ellen Martin, Director of Business Development and Stakeholder Relations. So as the board will likely recall, the Accessory Dwelling Unit Grant Program was introduced in September 2021, since which time staff have been working diligently to fully scale the program, and we're excited to have this opportunity to offer the board an update regarding those current and ongoing efforts. So I'll begin with a brief overview and refresh regarding the program, the eligibility criteria, and grant deployment process, and then I'll be turning things over to Cheryl Silva with Single Family, who can offer some additional detail regarding our implementation status and next steps. So next slide, please. So as you will likely recall, the ADU grant program provides up to a $25,000 grant to fund ADU pre-development costs for qualified households. So the grant program was structured to comport with administration goals of creating more affordable housing, furthering fair housing, and encouraging location and climate efficient site selection. With those objectives in mind, there are 3 categories of eligibility for the grant funds. The first category is low-income households, those households that are earning 80% or less of area median income. The second category is low or moderate income households that are located in a socially disadvantaged area. And we define that as a qualified census tract, or QCT, which is a census tract where 50% of households earn 60% or less of AMI or have a poverty rate of 25% or more. And then the final category reflects households that are low or moderate income, but have not accrued significant equity in their home. So those households with a cumulative loan to value ratio exceeding 80%. Next slide, please. So Cheryl will cover some of this slide in more detail, but this slide offers an introduction into the primary mode of deploying ADU grant funds. So we will primarily deploy ADU grants through our existing lender network with the locations of currently approved ADU lender branches denoted by the map on the left-hand side of the slide. So we're glad to note that our ADU approved lenders are well dispersed throughout the state, which will certainly help to maximize the efficient deployment of these funds. So a prospective ADU grant recipient will initiate the process by applying for a construction loan with one of our approved lenders. The lender will then roll eligible pre-development costs, costs such as permit fees, design, site work into the loan, and will pre-qualify the homeowner for the grant and send the application over to us at CalHFA. And then once approved, CalHFA will wire the ADU grant funds directly into the construction escrow account, which effectively allows the lender to reduce the principal amount due on the loan. Next slide, please. So as part of our program implementation, we've established a multi-pronged strategy to ensure that we can reach as many prospective grant recipients as possible and deploy the ADU grant funds as efficiently as possible. Our strategy relies really on 3 main tracks that we are largely implementing on a parallel basis. Track 1 is the primary mode of funding grants through our lender network, as I just summarized. Track 2 reflects an expansion of access to the ADU grant program for lenders that are not currently in our lender network. So that could reflect traditional mortgage lenders that offer a construction and renovation loan program, but it could also include non-traditional lenders, such as a local jurisdiction or a CDFI with an ADU financing program. And then finally, via Track 3, we are seeking partnerships with specialized ADU manufacturers and builders located throughout California who have direct access to these consumers that are looking to build an ADU and would likely benefit from the grant. So with that as an overview and introduction, I'll turn the remainder of the presentation over to Cheryl Silva. Cheryl has been leading the deployment of the ADU grant program and will offer much more detail regarding specific implementation efforts as they relate to each of the tracks I described. Cheryl?
Thank you, Ellen. Hello, everyone. I'm Cheryl Silva, and Single Family has been working with our approved lender network to sign on lenders that have renovation financing available. Currently, out of the 140 approved lenders, around 20 or so have this type of financing, and that is where we have focused our efforts for track number 1. Typically, when CalHFA launches any type of new program, it takes the lender approximately 90 to 120 days to implement the program on their end, depending on how the program is prioritized by their company. They need time to program their systems, create procedures, and train their staff. The first step is for the lender to sign the participation agreement. This is a legal document that will require their legal department approval and can add some additional time to the implementation process. As of today, we have 14 lenders that have completed this first step. The next step is for the lender to deploy the program and start offering it to the public. We have 6 lenders that have completed this step and are officially listed on our website. Once the lender starts working with a borrower on a renovation loan, they don't actually submit the file to CalHFA until they've approved the renovation loan. That typically takes 30 to 60 days, depending on contractor availability, weather, and/or city-county permitting processes. Our very first lender that signed up actually had a renovation loan that was already pretty far in the process, and they were able to get that submitted to us and approved. CalHFA's turn time for that approval was only 24 hours. The borrower was a moderate income with low equity, and the ADU was a 3-bedroom, 2-bath, 1,000 square foot unit and cost approximately $325,000. The $25,000 ADU grant paid for all of the permits for that ADU. For the next steps, we have an additional 4 lenders that are in various stages of deploying the program, and we anticipate they will be coming aboard in the next 60 to 90 days. CalHFA has been meeting with Fannie Mae biweekly to give a lender participation update. Fannie Mae and CalHFA have been collaborating to make sure the lenders are approved for the Fannie Mae variant, also sign up for the ADU grant, and vice versa. The first grant we funded was actually combined with a Fannie Mae homestyle renovation loan, and our marketing team is teaming up with Fannie Mae to work on a testimonial for this loan when the ADU is fully completed to show how successful our program and Fannie Mae's programs work together. Now that we have 6 lenders that have completed the onboarding process and have adequate geographic branch coverage, we will now start a full-scale marketing and communications campaign. Starting next week, CalHFA will be sending out communications via e-news and ramping up our social media presence. Just doing our original announcement back in September generated a massive amount of interest and phone calls. So we wanted to make sure that we had enough lenders to be able to handle the volume and provide good customer service. Next slide, please. For track number 2, CalHFA wants to make this program available to non-CalHFA approved lenders, specifically local government agencies that have ADU financing programs, along with several credit unions that also do their own ADU financing that is not from Fannie Mae or FHA. CalHFA has already been in contact with various local government agencies that have ADU financing in the planning and/or pilot phases. and are interested in combining our ADU grant with their program. The City of Oakland, the City of Pasadena, and the City of San Diego have already expressed interest in partnering with us. CalHFA has also been in contract with a few credit unions that work closely with the local government agency programs, and they have also expressed interest in partnering with us. CalHFA is currently working on business requirements and an approval process for these specific programs that would include a new participation agreement, application, and minimum qualifications. The next steps for this, CalHFA would need to work with our systems, our MAS system, to allow for a non-CalHFA approved lender to have access to just the ADU grant portion of our website. This is a huge system update, and we are anticipating this to be done by the end of the fiscal year. Once we have it up and running, we will reach out to traditional lenders that are not CalHFA approved, but do have renovation financing available. And then we will work with HCD and other organizations to reach out to local government agencies that have ADU programs as well. Next slide, please. CalHFA will work directly with ADU manufacturers and builders for partnership opportunities. We are currently reaching out to well-known ADU manufacturers. We are finding the builder interest is dependent on the market share in the ADU space. We are seeing a little bit of volatility. Some are increasing their ADU production and some are pulling back on ADU manufacturing entirely. So I think there is a lot of uncertainty in ADUs, and so we're seeing a lot of different approaches that manufacturers are taking. Marketing is working on marketing materials, logos, and a button link to CalHFA's site so that the builders can add that to their website, their marketing materials, and their application processes. The next steps, we will reach out to the ADU manufacturer to see if they have specific lending partners that are not approved with CalHFA, and we can reach out to see if we can get them signed up. That would be once Track 2 has been implemented. And so you can see we've been making great progress with getting lenders signed up, and with little time and patience, we should see reservations start to come in on these complex and time-consuming types of loans. And that is it. So I'm opening it up to any questions that anybody may have.
When you mentioned uncertainty, did anyone share what that uncertainty is?
Dawn, did you want to take that one?
I'm happy to take it too, actually.
Yeah, I think Ellen had the direct conversation, but yeah, go ahead, Ellen. Go ahead.
So we're finding that some of these ADU manufacturers are running into issues with identifying homeowners that are willing to have a renter in their backyard. So that's a bit of a headwind that they're facing. The other really big headwind has to do with construction costs and just the sheer nature of what it costs to put one of these things in, and ensuring that if the homeowner does indeed intend to rent that out, that the rental income that they can command for the unit justifies the cost of construction. So that's sort of the the time-worn story of new construction, right?
Yeah, sounds like market settling and figuring out what the market is. Things. Any questions from board members? Anna Maria, is that you asking?
Yeah. I know I hate that we don't have a little raised hand here. Yeah, I think I want to go back to the eligibility side. I'm just kind of curious about teasing that out, because I think one of the things that is going to happen in California, a lot of people have investment property that are higher income that could build somewhere else more affordably and be encouraged to do an ADU, but then they won't hit the income thresholds. And I'm wondering if we could entertain, statewide. I mean, we want the goal should be to encourage these to happen throughout the state of California. And I kind of feel like income restrictions kind of limit that ability to encourage, because the reality is it is going to be more moderate and higher income people who have the acreage to do this, that don't necessarily want to use their liquid cash to finance these and would look for a lending source. So I think we should be looking at really different markets and really who the market's going to be. And also expand it that, you know, again, a lot of, especially now with remote working, a lot of Bay Area incomes are moving to rural areas in California because they're able to work from home. But then to that lending criteria for that area, they wouldn't meet the threshold. So I think the criteria needs to be revisited and be a lot more flexible for California.
So the source of funding kind of determines the income that we have to abide by. So if we could get a source of funding that didn't have any income restrictions, then that could be a possibility.
And I was just going to mention also that just to make sure that we've been clear on it, the program under the different scenarios that Ellen and Cheryl talked about can go up to as high as 150% of area median income, which is the moderate range. What we don't do is market rate, and I think that's what you're getting at, Anna Marie. And I feel like I think we would also have to look internally at our statutes to see whether or not we would even be enabled to lend at a market rate as well. But I think Cheryl's point is the more important one, which is that the source of funds and the request of the administration in terms of how we approach these ADUs was targeted for the low and moderate income spectrum. So.
No, I understand that, but I think as we, as this grows and develops, that again, we're testing the market and we're going to find that the market is going to be, I mean, there's just so many different scenarios. I mean, you can have income wealth be cash strapped and not have the income of people who bought land many years ago that can't afford to develop it. Or again, the Bay Area example, Bay Area incomes moving into rural California, so I just think as we move forward and evolve in this, there's so many different scenarios that even play with the market rate that I think this is about production, because at the end of the day, it might be a market rate, but it might create an affordable opportunity for a low income family. And I think it's just looking at it through different lenses that creates a housing inventory in the state of California throughout the state.
Mr. Chair.
Yes, go ahead, Dr. Mbassi.
Yeah, Anne Marie, I want to thank you very much. These the questions were circulating without focus in my mind, but you said it very eloquently. I think you're focusing on a very large puzzle piece here, and as Mr. Kavir alluded to, and Cheryl did also, I think that we may be constrained by the legislation that guides CalHFA. I'm not in a position in government to suggest legislation, but if a well-intentioned legislator were to listen into our deliberations right now, an idea might spark to expand the legislative mandate to cover the very, you're talking about a very, very large opportunity here of individuals and opportunities of property that I think are not being covered by what we're dealing with. So thank you for bringing that issue up. And if there is anyone on the call who is in a position to suggest parallel legislation, well, there you go.
Great, let's start. Sasha, I saw you first, so go ahead.
Thank you so much. I saw that not only Deputy Director Dodson, but also Director Gustavo Velasquez are on the phone, so they might have more thoughts to share. But we've been talking to the CalHFA team about this work, really impressed by this strategy that they're bringing to the outreach here. And we've entertained a few case studies that we've seen really to address board member Ana Marie Farias's perspective, which is valid, that there are a wide range of homeowners with different income categories for their households that may want various opportunities that might not be a perfect fit for this program. But we're really inspired, at least at our agency, to see some models, particularly in lower income communities of color in Los Angeles, that are working very closely with housing authorities, as a board member Prince, you may be familiar with the LA MAS model, who's paired with the Housing Authority of the City of Los Angeles to partner vouchers so that ADU production serves specifically lower income households, households that may be overcrowded, households that may have low equity, or just be in a position to be able to accommodate ADU production. All that to say that even without a range of ADU financing types, the data that's been collected by the Department of Housing and Community Development has shown that in the last few years, statewide, without many funding types available, we've seen thousands of units getting produced, just ADUs. That this has increased dramatically with the changes in state legislation that have made it easier and more predictable for homeowners to have the right, without question, to build ADUs. And so we've seen from, I'm looking at the dashboard now, so I promise I don't know these off the top, but from 2016, there were about 1,300 ADUs produced statewide. And as the laws became clearer and the rules became more predictable around the state, this went up to 5,000 units in the next year. And then in 2019 and in 2020, there were 13,000 ADUs produced each year. And so we don't have great data yet on all of the homeowners and what their income level will serve, but I'm really inspired and heartened by the approach, again, that CalHFA is taking to think about how they do outreach holistically to meet low-income homeowners. But I'm all for thinking about what CalHFA learns in this process. And if there are gaps, I'd love to hear that back at a future board meeting. I'm sure the secretary would be interested in that as well. Thank you.
Thank you, Sasha. Ryan, go ahead.
Yeah, well, I appreciate the program as an effective means for producing naturally occurring affordable housing, but as well as subsidizing and promoting equity among low-income and moderate-income individuals. And to Ms. Kurgan's earlier point, just looking towards the County of LA's ADU pilot program, which also focused on target populations for housing within the ADUs, recognizing this is a smaller subsidy amount, so we may not be able to put as much restrictions on covenants. But to the bigger point, I also, well, first off, want to note the efforts that you all are expanding beyond traditional lenders to reach broader geographies across the state. Definitely a important note there. And again, to Ms. Kurgan's point, would love to hear more about purposeful outreach towards lower income households to access this type of funding. But focusing on one of the eligibility categories here, which is for, I think in essence, moderate income households within socially disadvantaged areas, and really specifically within the socially disadvantaged area category. I want to suggest that this might not be the best area to target this promotion of naturally occurring affordable housing, and that perhaps we should be focusing on the inverse of that in higher resource areas. If we're looking at this from the production side, that the target population here is likely going to be lower income households, thinking about the areas where we are going to be promoting that production. I think possibly looking at that, again, the higher resource areas and amenity rich areas, particularly from the transportation point of view. This would better align, I think, with the state's affirmatively furthering fair housing goals, as well as the recent statements in the budget around climate resilience and transportation access through housing as a climate strategy. But would be happy to engage with staff further around these areas of promotion of opportunity. Just thinking about that, a different way of thinking about this from a housing production point of view.
I'm sorry, Ryan, are you saying so if we get more affluent people to build this in their backyard, then poor people will come live in their backyard?
Well, I think that's like one population segment that you could think about as an eventual outcome, but not addressing the actual folks who can access the funding. You could still keep on moderate and low income household eligibility, but where those folks are living,
Gotcha.
Maybe not thinking about putting this within lower opportunity areas. Possibly this could lead to a concentration of poverty. I know the folks at HFA are familiar with this sort of line of argument, but rather thinking about where are we going to be promoting and subsidizing the production of this, low-income household units, naturally occurring, of course, should that rather be within areas of higher resource, so folks will have better opportunity from living.
the beauty of a new program is in a new market is you have a lot to discover. I remember one of the things I thought about is, how can poor people take advantage of this? And I think that they want to have grandma come live with them as well. And so this could provide an opportunity for low disadvantaged areas to increase wealth by building ADUs. So I think we're going to have to see balance across, but excellent suggestion. Thank you. Any other comments from board members?
Mr. Chair?
I saw, go ahead, Director Velasquez.
It looks like you had Director Prince and Velasquez raising.
Velasquez first.
Okay, thank you, Mr. Chair. Sorry for joining late, but I'm here, and I'm sorry I missed the presentation, but I wanted to ask the staff, Johnson Hall, or someone from your team, whether this program has any location benefit consideration. We've been working a lot with that location benefit lens, whether it's here in the programs at HCD or the bond program and tax credit program at CIDLAC and TCAC, whether it's higher resource area or the transit location, kind of the location efficiency. And so any consideration has been given on this location front?
Yes, is to answer your question, but I think this is also an area that we can expand upon. But right now, the program does have a focus on QCTs. But I'm listening really intently around some of the suggestions that have been brought up so far and writing them down. And I will say that I do think that there's room for us to really explore more deeply in those QCTs and those socially disadvantaged areas. Sometimes they overlap, sometimes they don't. But what does not change are the things that I've actually seen in the neighborhoods where I grew up, where actually people had ADUs and they didn't even know they had an ADU. I see that as a market in underserved communities that we haven't tapped yet, just as an example. So I do believe that this story is still written. This is a story that is complex. It's expensive to most borrowers. It's new to a lot of municipalities. And so I think it may take some time for it to catch fire, but it will over time, just based on the sheer need of affordable housing in the state of California. I know that I don't want to cut the conversation here, but because I know that there are other folks, let's continue to hear what other folks would like to share today on this subject.
I saw Anna Maria's hand up. Was there someone else, Anna Maria, before we talk with you?
I saw Preston. He can go. I can go after him. He's been raising his hand.
Yeah. All right, go ahead, Preston.
Thanks. I've been thinking that Michael's just out to get me today. I don't know. So I've really enjoyed this conversation. There's just been so much that I kind of want to just ditto. So I think the idea of the Housing Choice Voucher Program is way burdened. It's like really a difficult program to like figure out how to do additional set-asides or targeting, but I think that this is something that should be looked at and to try to figure out how to build upon what's happening in LA and think about how it can be done nationally. I do have to be very blunt, like in Santa Clara, our voucher program grew by 6% over the last 20 years. And we have 49,000 people on our wait list, and we have 1,000 people who turn the voucher in every year. So when all of a sudden we say, well, let's use a voucher for an ADU, again, it's just like this very difficult kind of formula. I just want to give a shout out to Build Back Better. Santa Clara would get 12,000 new vouchers when it passes. So I do think that I just want to reiterate, I think that we should be thinking about vouchers as well and think about how that works for every different agency in the state. I have lots of questions about how does this fit into our Building Black Wealth initiative, and how do we really think about homeowners who can take advantage of this and build up wealth. But that actually takes me to another level. I should say, I think working, as Ryan said, with the non-traditional lenders, originators is going to be important so that we can have that the growth within people of color being participants and being able to take advantage of this and creating wealth. I think that that's fantastic. So thinking about like who the lenders are, because we all know there are studies out there that show that if you have lenders who don't have staff who are people of color, that they don't originate as many loans with homeowners who are people of color, right? So thinking about who the lenders are is important. But I was thinking about like, what about the contractors, right? Not just the builders, the manufacturers, but there's still a contractor who's doing the foundation and doing some of the work at the homes. And I think that it would be really great to be thinking about how do we get small BIPOC general contractors involved in this process as well, so that we're building wealth within the contracting world, and maybe opening doors that haven't been opened before to getting equity and dollars and loans to or funding that allows the contractors to work. And then I was thinking about the community development corporations. There are so many in California that are either run by people of color or serving communities of color. And so I think, again, I heard that there's a lot of work that happens with community-based nonprofits. I think the example was LA. But if we can really build upon CDCs as that avenue, whether that they help with the loan origination, if they help with the outreach to homeowners in the neighborhood, I think it'd be really interesting to use that vehicle as a method to, again, grow and diversify the homeowners who are participating and at some level grow and diversify who might be living within the ADU. So I thought it was all very exciting to hear this program and to think about how it works. I, of course, have a whole nother set of questions about is it enough density, but that's a question as a multifamily developer for the most part. I tend to go that direction in density, but I don't think that that's part of today's conversation. So thanks. Just had to echo a bunch of things I heard.
I like the CDC thought, and in San Diego, as Mr. Russell knows, there's a Black contractor group down there that would be ideal to reach out to for exactly that reason. Good thoughts. Questions from other, okay, now you're ready. Okay, Maria, go ahead.
I'm sorry, Ryan just brought up some other, Preston did a great job as well, bringing up a lot of these points, but going to some of the points that Ryan was bringing up, I think this board needs to think about this. It's beyond creating housing opportunities that potentially low income families will live in these ADUs. I think it's much bigger than that. It's creating generational housing, especially for those of us who live like the Bay Area, very expensive areas, that families may now look at these opportunities to house, parents who, aging parents, children returning from college who don't necessarily want to return to the nucleus main household, but then you maybe have a junior ADU on the property. So I think we need to really, especially with SB 9 passing, really be thinking of the ADUs, the junior ADUs, and generational living that have people in different phases of their life income-wise. And like I said, it's beyond low-income families living with middle-class or higher income families. I think it's mixed incomes living together on these properties. Also, if many of us that watched the governor's press conference a week ago, he talked about the investment for California of bringing tourism back to California. Well, these ADUs are a space also for temporary short-term rentals of people coming to California. Also the workforce. Look at the healthcare industry. There's the traveling nurses and medical professionals coming from out of state to come to California. They're going to need housing. And so we need to look at it as opportunities to house the workforce as well. And also, we all need to get comfortable that as these generational households get created, that these are income opportunities. And I'm perfectly okay when people are having to buy $1 million or $2 million homes to have a rental income on their property through renting to someone else who necessarily can't afford to buy home ownership at the moment or needs a more affordable unit. And so again, getting comfortable with the different spaces, and also cities, getting used to what our communities are going to look like and land use changes. And as Preston said, with density, that single family properties now can now go to having 2 units to possibly even 3 or 4 units. So having that conversation and educating, and the more we talk about it, I think the better our policies are going to get and the better lending we're going to do, because I think the goal here is to create more production. And we're not going to create more production if we don't find the different areas that different people can play in the different spaces. And it does mean helping low income, but also being in that fair market space as well, because again, there's different needs that California needs. And I look forward to the dialogue. And I think we're off to a great start. It's been really exciting to see this from September to now. And I think staff are doing great. And I think there's just more people coming to the table, to the dialogue. And I appreciate everybody's energy in this space. As you all know, I'm very passionate about this topic because I just feel, Tina, I know you said this is going to happen later, but I think we are really on the cusp of, you know, ADUs really exploding in California. And I'd love for CalHFA to be the leader in lending in that space. So anyway, thank you guys for your help on that.
Awesome. Being mindful of the time, is there any other questions from board members?
I just had to laugh because of the question you kind of raised, Michael, which I am a renter. And my owner is talking about adding an ADU to my yard. And I went through that whole thing of like thinking like I run a housing authority, and like now all of a sudden I'm thinking I have to share a yard. Like, what does that mean to me? And so I was able to kind of go through that and think about it, and went back to the owner and said, of course, like let's figure out how to make this work. And but yeah, I think that there's got to be a component to help people understand that this is not a scary thing. Even though I'm just being honest, I had those thoughts myself and had to like address them. So I don't hold that against people when they have the same thoughts.
Thank you, Preston. And just thank you, board members. That was a great discussion. You know, it's rare you get to be in the start of a new market and get to ask questions like this. And, you know, that's the beauty of our service here at CalHFA. We get to ask these questions and hopefully improve these programs that impact more Californians' lives. So really great thoughts. I think everyone has enough to move forward. With that in mind, I think let's go ahead and move on to.
Actually,
yes, go ahead. I'm sorry.
Just a quick, if I may, Director Russell. So San Diego has been on the forefront of ADU liberalization, I guess you'd call it. And what we've seen is that explosion of new production. But if you overlay the production maps with redlining maps of the past, you will see that the formerly redlined areas continue to not be served, continue not to be producing these ADUs. This program is important because it does provide a path for wealth for those households. Those same neighborhoods in the redistricting, we saw an actual net loss of population in some of these neighborhoods because of a lack of housing opportunities. And so when we talk about the dynamic tension between high opportunity and traditionally underserved, there is a dynamic tension there. And climate goals, a lot of these neighborhoods are actually located very close to major job centers, but not sufficiently so that they're considered high opportunity. So we are losing population at near-in older neighborhoods that were formerly redlined. This program is one that very definitely speaks to a need for multi-generational housing in communities that have not been able to gather that wealth and to pass it along. So you know, these are complex issues. Obviously, there's no clear answer. I'm very pleased that we are stepping into one of the most complex areas, as we do as CalHFA. We don't do the easy stuff. So thank you for the time and space to have this discussion and for the work that the staff is doing.
I think Tina appreciates that. We don't do the easy stuff, right? Great. Well, speaking of hard stuff, our mortgage relief program update. Rebecca, I think you're up next.
Thank you, Chair Gunning and members of the board. As most of you, I think, know by now, my name is Rebecca Franklin. I'm the Director of Enterprise Risk and Compliance for CalHFA, and I have the great honor of serving as the president of the CalHFA Homeowner Relief Corporation, the corporation we have started to administer the California Mortgage Relief Program. As Tina alluded to earlier, we wanted to give you an update on how we're also helping Californians stay in their homes, specifically those who are affected by the pandemic. If we go to the next slide, what Tina already kind of broke the ice for me was we were approved on the 17th of December and launched the program fully on the 27th of December, being the third state in the US. I want to highlight that the team was able to turn around a launch in about 10 days, which I think is pretty great for the team to be able to do that and start. We realized the need is now, and so we wanted to make sure that we were starting to take applications and getting that assistance out there. If we go on to the next slide, I wanted to highlight kind of what the first 3 weeks of the program looks like. We received over 3,600 applications. We approved just over 60 applications. We signed up about 47 servicers to the program, and our website itself had 72,000 people visit to get information. Kind of highlighting the conversation we just had, I think it's a great accomplishment of the 60 applications we did approve, 64% were homeowners that were residing in those historically socially disadvantaged communities. So we also, as I highlighted in my last presentation, have a focus on ensuring that those homeowners receive these funds as intended. If we go on to the next slide, with the launch of the program, we did launch a new web page, and I wanted to highlight that for you. camortgagerelief.org website has a lot of information for California homeowners to go and visit, not only about our program, but other relief programs that are out there for them. It also gives them a little bit more information on the details of eligibility, and we have some tools for them to kind of determine whether this program would be a good fit for them or not, especially the AMI calculator. It's a calculator that someone can go in and put in their county and their household size, and it will give them the AMI because of the strict requirement we have with these funds, and that homeowners need to be at or below 100% AMI. We want to be very upfront with that information. Additionally, we do have information about the servicers who are participating in our program. I did say in the first 3 weeks we signed up 47. As of this morning, we're at 54, and I know we have a few more coming on deck. So I also want to highlight the information we're providing about potential scams. I think it's important for the board members to know, as we're talking about this program, as homeowners are looking at this program, this is a free program. This is a grant. And, you know, there are bad actors out there, and we really want to educate homeowners around the fact that no one should ever be asking for an application fee, or if you're entering into some sort of program where they're asking you to repay the funds, that is not this program. And we really want to make sure that we're upfront and that we do have a web page, a part of our website dedicated to not only educating homeowners around that, but also giving them opportunities to report if they do interact with anyone who is asking for that information. Going on to the next slide, we want to talk about the outreach. I think the board is very passionate about making sure that outreach is happening. It is happening to the right groups, that we're doing it in a culturally sensitive, in-language way, and we're taking that all very serious. I didn't highlight on the last slide that the website is available in 6 languages. Our contact center also is available to have in-language support. Since our last presentation, we have gone into contract with an intermediary community-based organization. That group will help us identify and vet other community-based organizations to start getting and doing outreach and navigator activities. The navigator will help be application support for people in those communities. We want to meet people where they are. That, again, this is sometimes an uncomfortable situation. People are in high stress. So we want to make sure that we're meeting them in a place where they're most comfortable with trusted resources in a language and a manner that they're most comfortable with. So the community-based organizations are essential to really be able to get that outreach and connect with these people. We also have conducted training sessions for all of the HUD approved housing counselors in the state of California. We had live training sessions twice a week for the month of January and the last 2 weeks of December. So that's about 6 weeks. We also have a recorded presentation to be able to make sure that the HUD counselors are aware of these options as Californians are coming in. As people are facing foreclosure or delinquency, we want them to make sure that they're educated on their options. Going on about more outreach activities. So we did have a lot of coverage. Tina did highlight the presser event on the launch the first week of January, but since we have launched, we've had over 33 articles printed in various languages, over 30 television clips, both in English and Spanish, and we have been conducting interviews in both English and Spanish. I also want to give credit to the secretary of BCSH. She also has been a very big supporter and help out, and she was able to do the presser event, and the fact that she can do it in both English and Spanish is amazing to be able to connect to those communities. We've also done over 20 radio clips, social media. We've had a lot of retweets of our thing. We do have the hashtag Get Caught Up, so if you want to start posting stuff, that's a great hashtag to be using. On the next slide, I wanted to highlight kind of that's the overview of the operations, but we do have an survey that we are surveying applicants, and not only people who've been approved, but just people who are going through the process. And we wanted to call out some of these direct quotes that we had gotten from the applicants to see that this is really impacting people's lives. And I talk about this as a stressful event for people, and I can't imagine being in their shoes. And I really think that, you know, the work that CalHFA and CalHRC are doing is just amazing work in really making a positive impact in these people's lives and providing them the opportunity to stay in their homes. We talk so much about how affordable housing is hard and buying a house is hard, so keeping them in their homes is also an essential part of this picture of our mission and the purpose of why we are here. So I wanted to end with that kind of highlight. I'm not going to read them, but I think that they speak for themselves, and then I welcome any questions from the board at this time.
Wow, that's awesome. I was just on the website and I plugged in Sacramento County, it worked fine. That's just good. Any questions from board members? Great program. Wow, that was thorough. All right. Kate, I think we're going to hear about the mixed income.
Chairman, can I just ask a quick question?
Yes, Director Velasquez, go ahead.
Thank you. When we were designing the rent relief program, we collaborated with other state entities around fraud detection testing. Have you explored the opportunity to do that kind of testing?
Yeah, so we obviously have collaborated with your team as well as BCSH, the Department of Financial Protection and Innovation, to talk about lessons learned with the rental relief program specifically, and have designed a lot of different fraud protocols within the program. We are working very closely with DFPI, Department of Financial Protection and Innovation, on the servicer signups and ensuring that people are getting signed up. We also have a lot of fraud measures in the program around validating the homeowner eligibility. We also have systems that are, you know, scanning for potential people who are trying to hack the system, and all the information. The system itself, the online application, and all of our systems have been designed with federal and state privacy and information security protocols in mind. All of the HRC personnel are trained both on information privacy and information security protocols, as well as looking at fraud and reporting that. We have an independent third party vendor who has gone through and designed over 300 potential fraud schemes, which we have outlined mitigating efforts for. When you have the director of enterprise risk running a program, fraud and risk is the #1 priority. So
I would also mention, thank you, Rebecca. I would also mention that we have also very closely connected with NCHSA, which is the national organization centered around housing finance agencies. And I am in the process of putting together a meeting in participation with both Washington and Oregon, and Alaska and Hawaii is now asked to jump in so that we can coordinate very closely with them on a quarterly basis, have conversations about some of the work that we're doing to see how they're managing their process as well. So this is, as Rebecca said, we got the right person in charge, our head of our compliance and risk management, but we're not relying on any one thing to make sure that this program is delivered well and gets to the right people as quickly as possible.
Thank you, Director Velasquez. Any other questions? All right. Kate, now's the update time on mixed income.
Thank you, Chair Gunning and members of the board. I know we're coming up on the end of the hour, so I wanted to, today I'd like to give you an informational summary update of the 2021 MIP outcomes as they compare to previous years and give you a very quick look at the changes we've made to the program for 2022. And for the record, my name is Kate Ferguson. I'm the Director of Multifamily Programs. Next slide, please. Sorry. So first, this is a summary of our production. I wanted to give you information related to the actual production of the mixed income program. One interesting metric here is that the program has financed 5,552 units since its inception in 2019. Unit count in 2020 was exceptionally high, given that the program received an injection of funds from AB 101 in that year, so you'll see that bump. Another metric I'd like to point out is the total development cost per unit, which was flat 2019 through 2020, but jumped approximately 20% last year, reflective of the increases to cost that we've seen throughout the industry as a result of the pandemic. In 2021, CalHFA received 44 MIP applications and allocated MIP funds to a total of 13 projects. Unfortunately, one of those deals fell out due to the competitive environment at CIDLEC and the finite amount of bond cap we're experiencing. Next slide, please. As you all know, MIP has morphed over the first 3 years of its life, with major changes being the transition to an over-the-counter program and a defined focus on readiness for construction, cost efficiency, and subsidy efficiency. In 2021, we added a ranking mechanism to the term sheet, given the significant oversubscription of the program. In 2021, CalHFA received 44 MIP applications and allocated funds to 13 projects. As I said, one of those projects did fall out due to the finite amount of bond cap that we had in the MIP pool at CIDLEC. Next slide, please. CalHFA continues to closely track the geographic distribution of MIP projects throughout the state. As you can see here, the counties with the highest participation have been Contra Costa with 20% of MIP units funded and 17% of the projects that have been funded. Then comes Sonoma County with 13% of total units and 17% of total projects. Sacramento is next with 11% of total units and 11% of total projects. And Los Angeles is in the 4th position with 11% of total units, but only 6% of total projects. It's because their projects are larger than the norm we see through the program. Historically, CalHFA has had a cap on how much MIP could go to any one county in any year, and that cap has been 33%. This is one of the terms that will change with the 2022 program. We've taken this to 25% to ensure that we are continuing to focus on balanced geographic approach. Next slide, please. As I look at this slide, it's a little busy. Believe you all received a copy of the PowerPoint, so if there are any questions afterward, but I do apologize, it's a little busy. I wanted to point out the AMI distribution of the program in its entirety, the blue bar being 2019, the orange bar being 2020, and the gray bar being 2021. You can see that the mix of unit affordability has changed over the years, while average affordability was flat at 60% in 19 and 20 and went down 3 points in 2021. As you all know, in 2021, CalHFA did not allocate MIP awards to units in excess of 80% AMI. Additionally, a requirement for ELI and VLI units was included in the 2021 program for the first time. What is the good news is that all 3 years delivered a wide range of unit affordability, which is the point of the program. And as you can see from the bell curve shape, it's continued to stay consistent in its distribution. We expect that this to be an ongoing outcome of MIP with higher AMI units, providing the economic support to those units serving ELI and VLI tenants. Next slide, please. So this is another slide showing the distribution of all units over all 3 years financed that have been financed. Given the reticence of the investor market to finance units which exceed 80% AMI, I expect this distribution to remain fairly stable over the next 24 months. Next slide, please. Finally, and quickly, I wanted to give you an update on the changes we've made to the MIP program in 2022. We launched our term sheet on January 4th, and the primary changes are listed here. First, CalHFA has been actively involved in discussions with our state partners around climate goals and decarbonization. And historically, MIP has been very focused on maintaining efficient use of state resources, and as such, HCD programs, which could be combined with MIP, were very limited to only the infrastructure grant program. In 2022, the MIP term sheet expanded allowable HCD programs to include the AHSC program, which is managed by HCD on behalf of the Strategic Growth Council, and also HCD's Transit-Oriented Development Program. Both of these align with the climate goals that are being discussed across the state by the administration, and which we want to firmly support. Other changes in 2022 include changes to the priority ranking of projects to include all state resources in the calculation of efficiency. Previously, we were only including CalHFA resources, so that will be a better measure and will more closely align with CIDLEC's scoring. Updated affordability requirements will include a minimum of 30% of the units at or below 50% AMI. That's up from a minimum of 10% last year. So this change we're making to align with the administration's goals for more ELI VLI units. Additionally, we are reducing our average affordability maximum from 60% AMI to 55% AMI, which is in line with investor requirements in the broader LIHTC market. Finally, and as I already mentioned, we have reduced the maximum available MIP per county from 33% to 25% to ensure a broad distribution throughout the state. Our new term sheet was posted on January 4th, and our application deadline of February 11th will be posted on our website today. All MIP applications will be submitted to the first round of funding in 2022 at CIDLAC, and will once again be paired with up to $200 million in state tax credits as allocated by TCAC. And that's just a brief summary. I'd be happy to take any questions that anybody might have.
Questions or comments from board members?
Mr. Gunning. I remember, and not to put Anna Maria on the spot, but I think she and I were the ones who probably, though Stephen, you were probably there too, that had the most questions about the middle income program a couple of years ago when we talked about it. And to be quite honest, you've kind of raised a bunch of questions now that I just feel like we have to revisit again at some level. And so if you look at like that affordability chart, I mean, the whole idea of the program is to get above that 80% level, and really the tax credit program with the opportunities now to have the blended household incomes, you can get up to 80%. And so I would love to see like what's the comparison of the middle income program and the use of 4% tax credits and the targeting of households versus the competitive 4% and what's happening there. I would love to understand, and Gustavo, you know so much better than I, so I'm about to get into trouble, but I think very few communities are meeting the RHNA goals for units produced below 30% of AMI. And again, I feel strongly that we're missing the boat if we're not serving households at 30% of AMI. I get it that most developers who do that need to access vouchers. I've already talked about the scarcity of vouchers, so I get it's a problem. But one of the goals then of the middle income program should be figuring out how do we cross-subsidize the funding within a development that allows for deep affordability to extremely low-income households. And that to me would be a great program to really figure out. And so because I know Mid-Penn has a project happening here in Santa Clara that's going to have some ELI units that has no voucher associated with it. That is great. We basically have been with the voucher program, moving the chairs on the Titanic, and we're just serving, we're having a different owner, but we're still serving 30% of AMI units. And by the way, when I said we have 49,000 households on our interest list, 85% make less than 30% of area median income. So that's like, I can't even do the math, but it's 40,000 households, right? That are ELI households that are not being served when, and so again, I want to really understand, like, as these dollars shifted from the 4% program over to the middle income program, and we've seen, and as I saw that chart and not understanding it completely and wanting a comparison to, to the 4% program, it seemed to me there are very few units serving 30% of area median income, which I really believe is our, Jonathan, I'm going to steal your words maybe, that's who we should be like figuring out how to serve in many ways, right? I mean, that's the mission and purpose. I get it, there's a housing crisis for all income levels, but that ELI group is, I think, suffering tremendously. Again, I do believe that most communities are not meeting the RENA goals for 30% AMI. And so I just want to know, like, are we helping? Are we hurting? And I don't feel like these answers, the questions that we raised a couple of years ago have been answered. And it just kind of continues the asking, I think, of additional questions.
Yeah, thank you so much, Chair. If I may respond to Director Frank. Thank you. So just to revisit, this program, I did hear several references to the middle income program. This is not a middle income program, nor has it ever been. It is a mixed income program. So we always envisioned that we would be supporting, and the bank was, and the board was actually quite supportive of this program, a range of incomes, because when this program was developed, the administration recognized that we needed to hit affordability levels at all levels. And the administration still continues to support that. That hasn't changed. What has changed is a focus, a continued focus on ELI and VLI. And so in response to that, and as Kate mentioned in her presentation, we have lowered our standard, our terms, so that we could pick up more of those ELI, VLI. But we can't change this program altogether, because this entire program has been legislated as a mixed income program. So that we can't change. And so because I think that both the administration as well as many folks who are in the affordable housing arena recognize that we need to have a solution for AMIs that go up to 120% AMI levels. And so we'll continue to work at that level. Now, I believe that will change in the current calendar year. And because both TCAC regulations as well as SIGLET regulations have changed to have a greater focus on ELI and VLI units. So I think what will happen is the development community will respond accordingly. So we'll see some of those changes happen, and we're ready and positioned to address that when it comes. So
if I
clear on that. Thank you. Go ahead.
Address one of your questions, Mr. Preston. Last year, the overall average at SIDLAC, which I believe is what you're asking, for the overall average AMI level for all deals going through was 51%, and our overall average for our program was 57%. This year, we are reducing our overall average to be no more than 55%. And if you look, and I don't know, Courtney, if you can go back to slide 5, but we are over 30% of our units are at 50% or below. And I believe that we have right now, yeah, thank you, Courtney. So you can see from this, if you look at 2021, we have more deals. We have 13% of the deals in 2021 were at 30%, which is up from 3% in 2020 and 5% in 2019. And as Tina said, the point of this program is to do a wide range of units in one project so that the higher income units can provide sustainability to the lower income units because of the need for vouchers and because of the lack of vouchers in the market. So we maintain a required spread of 40%. So if you have 30% units, you need a 70% unit to support that unit. And what we found is that that leads to a long-term financially sustainable model and project economic model that makes a lot of sense. And that is frankly where the investors are as well. So I understand what you're saying. Not having been here in 2019 when you had these conversations, I hope that answers some of your questions, but that's where we are today.
So I totally appreciate it. I'm in the midst of a book, What Works to Promote Inclusive, Equitable, Mixed Income Communities. So I think it's a very important topic. But you know, the ratios we have looked at for a while is like 1/3 being at ELI. And so even 13% is not getting to, again, the 40,000 households on our interest list. And I guess that I don't really understand the numbers, but I believe that we requested or received $150 million last year, but we returned $100 million of that. And now we requested $200 million through CIDLAC. And I believe those are the numbers I saw kind of floating around. And again, when I think about how we have $1 billion in Santa Clara targeted to unhoused individuals and extremely low-income households, and we're not able to, as a county, to access the 4% because it's shifting over there, it becomes harmful to the vision that the local community has. I hear what you said, Tina, that this is legislation, it's coming from there, but I just feel like it's more complicated when I look at what's happening here. I struggled with this program when I was in Fresno. I saw that there was one development that was done there. I just continue to have questions, and I totally appreciate it. Like, we're trying to figure things out. I just want to make sure that we, put some of those values out there that are important to us as an organization and as a community. That's part of our evaluation.
Thank you, Mr. Prince. Any other questions or comments from board members?
Just a comment, and you'll have to forgive if you're picking up any ambient leaf blower noises. But I just want to first off applaud the effort to align the program with other HCD funding sources and just encourage the continuation of conversations to look at more than just eligibility criteria alignment and thinking about incentive alignment. Recognizing target populations and statutory goals can be different between programs, but in the way that we measure criteria, for example, location efficiency or funds leveraged, those can be aligned and really lead to an incremental approach to increasing accessibility of funding for developers. So they don't need to continuously revise applications and project design. This could lead to potential development cost savings, but also sends a clear message around state priorities and how we measure those different goals, and lend some level of certainty to developers. So yeah, great job, and just would love to see the conversation continue.
Thank you, sir. Okay, we're going to close the show with the great presentation from Sasha. Kurgan, you're up. Pressure's on.
Pressure is on, and I realize I'm standing between everyone and their lunch, except for those of you that are off camera. I will try and keep it quick, though. For the record, my name is Sasha Wasatsky-Kurgan. I'm the Deputy Secretary of Housing and Consumer Relations at the Business Consumer Services and Housing Agency. Good afternoon, board members and stakeholders. I really appreciate the opportunity to present to all of you today. I am here on behalf of Secretary Lourdes Castro Ramirez, and I'm excited to share with you detail about Governor Newsom's budget that's proposed for 2022 through 23. That's called the California Blueprint, and you'll probably hear me refer to it as that. As Executive Director Johnson Hall mentioned in her opening remarks, the governor's budget states really plainly that the housing crisis is daunting, it is challenging, and nonetheless, there is optimism, hope, and a lot of resolve to continue efforts to address that crisis. So today, I'm going to give some background about the California Blueprint and then really focus on an overview of proposed investments in homelessness and housing. Next slide, please. So first, I'll zoom out for a moment and talk about the governor's proposed blueprint for California, which directly confronts some of the state's largest threats, not only in housing, but while bolstering our state's strong economic growth and continue making historic investments in California's future. To that end, the governor's plan really doubles down on a lot of the work of the last several years responding to COVID-19, addressing the climate crisis, and the climate crisis is an overarching theme in this year's budget proposal. But really tackling these hard issues of including worsening wildfires, the drought, persistent inequality and homelessness, and keeping our streets safe. Meanwhile, the blueprint offers a vision for how California can continue to tackle short-term crises and long-term needs. Last year, as we wrestled with the upheaval caused by the ongoing upheaval caused by the pandemic, the state passed the largest recovery package in the nation, which was referred to as the California Comeback Plan. That provided short-term relief to millions of Californians and made billions in longer-term investments that benefits workers, businesses, families, all the stakeholders of CalHFA really for years to come. So that vision from the California Comeback Plan persists this year, in part because our challenges persist. As we know, and many of us have felt, or our families have felt, the pandemic laid bare many of these most striking disparities in our state: unequal access to healthcare, childcare, education, and the economic ability to endure this rapidly changing and very unpredictable world. So today, as our state's economy still drives a still recovering nation, the governor's offering a model for how we can move forward together. So this blueprint, the 2022 or 2023 through 2023 budget, calls for billions more to fight COVID, educate and care for all of our 40 million residents, and prioritizes the safety and security of Californians, really reinforcing California's role as a global leader in climate protection, innovation, and job creation. Just to put a finer point on the prior year investments, Governor Newsom's California Comeback Plan included over $10 billion for housing and over $12 billion for homelessness. Some of those programs you've actually heard about today. Next slide, please. So from now on, I'm going to zoom into our collective areas of expertise. The 2022 through 2023 proposed budget includes $9 billion for housing resources and $8 billion to reduce and prevent homelessness. This strategy is really focused on maintaining momentum in addressing the continuum of solutions to both accelerate housing production and also reduce and prevent homelessness. We're focusing on building on successful programs, including the mixed income program, which we just heard about. Next slide, please. So first, on homelessness, the blueprint includes $14 billion in total to prevent and reduce homelessness. And I should note, if you're interested in this, the budget summary covers a lot. The leadership that's at the California Interagency Council on Homelessness. This was formerly known as the Homeless Coordinating Financing Council. This California Interagency Council on Homelessness, that is a mouthful. It's referred to as CalICH at times. It is co-chaired by Secretary Castro Ramirez and Secretary Galley at the Health and Human Services Agency. That relationship kind of outlines some of the strategy that's in this budget. And you'll see here on the slide too, investing in life-saving health and human services that connects individuals and households into safe and stable housing by adding $2 billion to the historic pandemic response, which includes really a focus on aligning behavioral health through the Health and Human Services Agency with a range of housing options to meet people where they're at when they are at risk of or currently experiencing homelessness. I should note there is an error on this slide. So there is an add of $2 billion. That add actually includes $500 million to the encampment resolution program. So that fourth bullet should be includes, not adds. $2 billion in total, including $500 million to the encampment resolution program, which was just launched last year, towards the end of last year, by the Homeless Coordinating Financing Council, already receiving tremendous demand from applicants around the state. And the governor's proposal is to do more, to add an additional $500 million for this purpose, to really keep focus on encampment resolutions, but also making sure that individuals that are in households that are in encampments are being connected to housing opportunities. Next slide, please. Thank you, Courtney. You are on it. So next on housing, the governor's budget proposals includes $2 billion in total, focusing on two main themes, really aligning housing and climate and really affirming and articulating a lot of the work that's already been done in this space. And then also accelerating affordable housing production more broadly defined. I'll cover these in detail in the next two slides. Next slide, please, Courtney. Great. So the state is going to work on funding solutions to build sustainable and equitable communities across the state in targeted areas, continuing our state's work to include housing as part of the state's climate strategy. Just on this board today, you have representatives both from SGC, from the Strategic Growth Council, and from the Department of Housing and Community Development, who lead and manage, respectively, the Affordable Housing and Sustainable Communities Program, which is really a great way to synthesize what this vision can do. When we align housing, transportation, and other investments to make sure that we're creating more integrated communities where people not only have opportunities to reduce their rental cost burden, but their transportation cost burden, being closer to jobs, being closer to healthcare. Through all of that effort, which just makes sense, and how a lot of planning used to happen before we got into our trenches, really also has great climate outcomes by reducing greenhouse gas emissions, making shorter trips, providing alternatives to single occupancy vehicles, and things like that. So this budget proposal includes an additional $300 million in the Affordable Housing Sustainable Communities Program directly from the general fund. So this is an infusion to the existing program, which is currently funded with the Greenhouse Gas Reduction Fund. No major change to the program or anything like that. Just really, I think of this as recognition of the program's success and additional opportunity to do more. This also includes $500 million in the Infill Infrastructure Grant Program administered by HCD, really to make ready and meet communities in their infrastructure needs to lay the groundwork for affordable housing production. Additionally, within this $1 billion, there's an opportunity for us to continue leveraging our state assets, and that is our existing inventory of state excess properties, not even local surplus properties, just state excess properties that are available for affordable housing, making another $100 million in investment, really an initiative where we're using our public land for public good. And an additional $100 million in, this is a new program, in an adaptive reuse program, removing barriers to using existing structures that can be converted into housing and reduce greenhouse gas emissions, not only by limiting the greenhouse gas emissions that come from new construction, but also by investing in the infrastructure in the cores of our communities around the state. All these programs really articulate that connection between housing, transportation, jobs, and climate goals. And I am so elated as somebody who's worked on this issue for a long time to see that as such a focus in this budget proposal. I should mention there are other investments not covering in this slide deck, but they're in the budget summary related to decarbonization of existing buildings, some investments targeted towards lower income households, some with appliance rebates more broadly defined, but that really invest in the health and safety of residents and also in reducing greenhouse gas reduction goals. Next slide, please. Okay. So here, this part of the blueprint includes a proposal for another $1 billion to accelerate housing production. And this slide is highlighting just two components of that, but one that are of interest to the board, an additional $200 million for CalHFA's mixed income housing program. This is split over 2 budget years, so it's not $200 million all at once. I'm sure we'll hear about that and see how this budget proposal pans out really in the next few months. But I will not repeat any of what Kate just said, but just to say, I think the executive director also mentioned this. This is kind of evidence of the affirmation of the success of the MIC program and recognition for hard work and good outcomes. There's also an additional $500 million to continue. This is the 4th year of this infusion to bolster the state low-income housing tax credit program. So that's $700 million. Where's the additional $300 million? If I said this is $1 billion, for those of you that may be keeping track, this is $200 million in a portfolio reinvestment program, which is a program that HCD started with this year's budget, working really on their existing portfolio and taking some of the lessons learned from this first year and expanding that in future years. And then an additional $100 million to support mobile homes, which is a very important part of our housing stock. HCD has long run a program. This budget proposal includes some ways to make that more effective. Board member Prince may be familiar with some mobile home park acquisitions in his current jurisdiction, and probably also some cases in Fresno, as are all of us. Mobile home parks exist throughout the state. They serve seniors, families, folks with disabilities, people on limited income, and this $100 million will provide a way to improve the prospect of increasing health and safety in those communities. So really excited to see not only the climate strategy, but affordable housing broadly defined. These do not need to be mutually exclusive, but just really this is how it's articulated in the budget. Next slide, please. This was already a lot, but as all of you being intellectually curious people, if you want to learn more, you can find about this on the Department of Finance's website. It's listed here, ebudget.ca.gov. You can email me directly if you have any questions, or also our whole team at agency that works on housing, housing@bcsh.ca.gov. Thank you for this opportunity. I'm happy to take questions, but I also defer to Chair Gunning on how you want to move through the agenda.
Chair Gunning, I have one comment, one question real quick. This is Preston.
Go ahead, Preston.
So I thank you. I thought that was a great presentation and overview, and I think that there's a lot of excitement over the blueprint and the investment in housing, and so I think it's fantastic in many ways. And so I just want to say thanks for that. And I know I heard from someone, I can't remember, it was Tina who said at the very beginning, we got to read the blueprint. So it's on my list. I highlighted it, read the blueprint. So the question that I have or comment is really around the Home Key program, which I think is really fantastic in many ways. But the Turner report looked not just at California, but nationally at the conversion of motels into serving those who are formerly unhoused. There are definitely issues with interim housing uses for motels and the sustainability and viability of those developments. I think the conversion into permanent housing that includes permanent supportive housing has been pretty successful, particularly when it includes vouchers. We are, as a Move to Work agency, looking at how do we provide some kind of alternative rental assistance to the interim housing sites. It is great, except for, again, we've had 1,000 new vouchers added to our pot over the last 20 years. And what's happening is everyone who's looking at an interim housing or a home key is like saying, oh, by the way, we're going to add a bunch of vouchers. Well, again, if we have 1,000 units turned and people are proposing 10,000, there really is a proposal of 10,000 units here in Santa Clara County, and they want vouchers for all of them, it just isn't viable. So I guess the question comment is, has the governor started thinking about rental assistance as part of making those developments work? Because right now, kind of turning to housing authorities and our limited resources at the federal level, it's just not going to sustain itself. And so I would love to, maybe it's just putting that idea in there. And I think about like the housing levy up in Seattle. When they did the first levy, it was for capital funds, but they eventually got to the point where they did I think the last 2 housing levies. Every 7 years they do a levy, but the last 2 included rental assistance to make sure the developments work and were sustainable. So I just want to make sure that that's on the radar, that vouchers alone are not going to solve the problem. And I want to give one last shout out, just so, and I'm sure this happens everywhere, The $1 billion housing levy that was passed here in Santa Clara County has done 36 housing developments, permanent supportive housing units, supporting 3,000 families. In the end, over 20 years, the Housing Authority is going to contribute more than the $1 billion in housing choice voucher assistance. And so these levies and these capital investments aren't working if we're going to serve ELI units and formerly unhoused households unless we have rental assistance as part of it. So either we got to advocate for more at the federal level, or governor's got to help figure out how to make that work locally.
Yeah, we're definitely at agency thinking about the partnership that's required and has been so valuable in deploying efforts like HomeKey. One benefit that we have is that while we can provide capital sources, including those that are in HomeKey and other programs that can make rental assistance dollars go further, I am not saying that there is enough. So we will continue our federal advocacy efforts. We will continue partnering, and actually I'll be talking to a bunch of housing authorities in the coming months. So I'd love to put you on my list, Preston. But we're thinking about even things like fair cloth units that have been underutilized, like really digging deeply into all of the resources that are here in the state. I will also mention, I don't see Gustavo on, so I'll just take this opportunity to mention that the first round of HomeKey, yes, was much more limited in the uses and in the operating subsidy allowable, but this current round is more expansive and allows for a broader range of income levels to make sure that existing households in assets that that may be multifamily housing already, that no households are displaced, along with increased operating support. It is shorter term. It doesn't need the long-term pro forma that you're mentioning, but it is not nothing. And it's a dramatic increase from the first round. But yes to more partnership. Thank you so much for the comments and for being brave in stepping into the first round of HomeKey.
Well, and then so in addition to the book I'm reading, I have the Turner Report over here. So there's just like all kinds of amazing information that's out there right now. And so, yes, I'd be happy to talk with you and help organize as Secretary Castro. She has a history with housing authorities, no doubt about it. But as she knows, I have a pretty strong connection to housing authorities here in the state and would always be happy to help facilitate conversations. But anyways.
I love that so much. I should also just, sorry, last thing is that some of the barriers that you mentioned and are identified in the Turner Report, we hope can be addressed directly by the adaptive reuse program. So really removing barriers to some of structural fenestration and other costs that really increase construction cost and make it more viable as a housing use instead of just converting to another market use. Mr. Russell.
Yes, just really quick, I do want to underscore Preston's remark about rental assistance or operating support, because that's going to be critical. We need to see those dollars for these things going to be sustainable. Also, the services, I think this is something that is overlooked sometimes, is that we are really, first of all, we're not able to pay what really is needed to keep people in these positions and services and permanent supportive housing. These are intense positions. So recruitment is hard, pay is hard, retention is hard. We need more service dollars to make this work, because a lot of folks who are operators are actually fundraising as C3s to actually supplement what is provided in terms of service dollars. So I want to put a pin in that. And then lastly, I just want to underscore again the dynamic tension between what our climate goals are and sometimes what our opportunity maps drive us toward. I get that we're doing, AFFH is important, but there's this dynamic tension where there's opportunity area or locations easily accessible to opportunity areas that aren't themselves considered high opportunity, connected by good transit, where we're not able to invest in some of our urban neighborhoods because they don't meet the qualifications through CIDLAC and TCAC, but would be great climate goals, and in fact are actually connected to high opportunity areas. So this dynamic tension, I realize it's a choices out of scarcity, but I don't want to look away from the problem.
I appreciate that so much. There's more detail in the budget summary, but there are some current efforts where we're really trying to look at existing streamlining tools, not ignoring areas that are in high and high resource areas, and also where housing can and should happen because of transit investments and other infrastructure and other amenities for all the reasons that we all know. So we are continuing to highlight what existing tools exist, and then there's some language in the budget about what the administration is open to.
Great, Sasha, thank you. Any other comments from board members? All right, I want to draw your attention to our regular reports on single-family, multifamily loan production, and of course, we already have the presentation on the mortgage relief program. Are there any other items to be raised by board members today, or any other issues to present to staff? Awesome. I now ask, is there any public comment or any members of the public that would wish to comment at this time?
So we'd like to have anybody who's interested in commenting, please raise your hand and we'll call on you. And at that time, if we'll unmute your mic, and then you'll need to unmute your mic as well. We do have a time limit of 3 minutes per member, depending on the volume of questions that we have. And I also want to draw the public's attention to our public comment guide, which is available in the handout section or on the CalHFA website. And it gives you a number of options to provide comments to our board of directors. I thought I saw a hand raised, but I do not see one now. Okay, Courtney, do you want to go ahead and see who we have available for questions or who's interested?
Yes. Okay. We have an anonymous viewer that would like to make a comment. So, anonymous, you are self-muted right now. If you would like to make a comment, please unmute yourself. Go ahead.
Hi, good afternoon. Can you hear me? Hello. Yes. Hi. My name is Tracy Polanitz, and this question is for Rebecca Franklin. I applied on January the 3rd for a home assistance, and I've been listening to you guys for the last couple of hours now, and she submitted, I was looking at the slide, and it said 3,600 applications have been submitted and 60 have been approved. Mine has not been one of them so far, but I hope that it will be. One of the questions, when I called the 1-800 number on the 14th, I asked if there was any way that you guys could help pay for these $25,000 in assessments that my HOA board is asking for. They're doing construction now, and they want the homeowners to pay for it. I'm a first-time African-American homeowner who bought her first condo in 2019. I work in television. I'm not working right now until next month. And even if I was, I cannot pay $25,000 in homeowner assessment fees, plus my $2,000 mortgage, plus my HOAs that just went up to $265 on my own. And when you call the 1-800 number, I'm sure it's someone that's working from home. I know I have 3 minutes and I'm hurrying up, but I want you guys to understand. The representative on the phone told me that a poll was taken and that Californians only want their mortgages paid. But if I don't pay my mortgage and somehow come up with this $15,000 plus for these assessments this month and $10,000 in 6 months, that's just not possible. So if I don't pay my mortgage and pay these assessments, that's the only way I can become eligible to receive the money to pay these assessments. Or if I pay these assessments and don't pay my mortgage, like, it's the same thing. It's all tied together. I don't want my credit to be screwed up because I can't afford $25,000 in assessments. That is not my fault. That should have been handled before I came over here, but that's neither here nor there. So that's my question, because it says an article on BGR.com on the 13th of January that these assessments could be used for everything from taxes, association dues, and other payments associated with homeownership, even the payments like of utility bills and insurance costs. Thank you.
Rebecca, are you still on the line? Can we get back to Tracy with an answer?
Yes, of course. We will get back with a response to Tracy. If you can, Tracy, if you can send Courtney or put into the chat a contact email or phone number, we can respond to you.
Great, thank you. Any other members of the public wish to comment? Courtney, is there anyone else?
I'm not seeing anyone else. I think that was it for this time.
All right. Boy, nothing like a good meeting to start January. We're off and running, huh? Awesome. Is there a motion to adjourn? By acclamation?
No, we're having too much fun. Let's hang out a little while.
Thanks, Preston. Thanks, everyone. We'll see you next month. Good to see everyone. Thank you.
Bye-bye.
Bye-bye.